Put out the big global story, except the big global story from Sunday and today this morning is Italy, the referendum in Italy, which is actually a big no, right? Now, we haven't seen very much by way of market mayhem. Actually, Asian markets in this morning were under a bit of pressure, but we haven't seen anything dramatic at all. One reason perhaps also is because Europe hasn't started trading. So European markets will open at, 1:30? European bond markets will also start trading around 1:30 or so. That is when the real reaction will start to come. I just want to put out one very simple graphic, which I think is key to tracking this entire Italian crisis. That is nothing but the spread of the Italian 10-year yield over the German bund. The reason why I'm saying this is, the key signal to watch is because Germany pays the least amount to borrow money. Italy and some of the other peripheral markets pay more. The graphic on your screen just right now says that, as I said, markets haven't reacted to it because they're not trading as of now. But right now, to borrow for Italy to borrow, it pays about 1.6% higher than what Germany pays to borrow. The beginning of the year, that was 1%. This also means that there has been slowly this expectation, especially since summer of 2016, that there is a referendum which is going to be held when the announcement was made, and yields have crept up. So from the beginning of the year itself, they are up about 60 basis points. The peak of the sovereign crisis in Europe, right? When bond yields across the peripherals went through the roof, that time, what Italy paid was about 500 basis points higher than what Germany was paying at that point in time. So I think, if you want to watch one thing, you watch this to kind of assess the impact of the Italian crisis for not just bank stocks. This and market volatility has a direct impact on, Italian banks, for example, have a large sovereign exposure, about $400 billion or so, right? Yields go up, banks lose money. So I think we'll have to kind of keep this in mind when we look at how this Italian saga kind of unfolds. So far calm, but as I said, that's also because markets haven't started trading yet. You could also look at the euro, but the point is euro has been under pressure because of dollar yields, right? The dollar and a couple of other influences as well. So if you want to just track this sort of event, this is a kind of a sort of better metric to track and see whether markets are pricing in any amount of risk on the yield side or not at all.
Okay, well, as of now, at least